Today, another bad UK inflation print signals higher rates still. Recession incoming? Hello again, it's Martin North from Digital Finance Analytics World. Latest post covering finance and property news. Well, the UK inflation number has just been delivered, and it remained higher than expected for a fourth month, leading to a fresh flurry of bets on high interest rates as consumers struggle with soaring mortgage costs. The Consumer Price Index rose 8.7% in May. That's the same as a month before, according to the Office for National Statistics. Core inflation, excluding food and energy, though, accelerated to 7.1% from 6.8% when the markets were expecting a fall. Economists had expected a headline reading of around 8.4% and that the core was to remain unchanged. Two price measures being closely watched by the Bank of England for signs of domestically generated inflation actually picked up again. Core inflation, which excludes volatile food and energy prices, accelerated to a fresh 30-year high of 7.1%, while services prices increased by 7.4%. That's up sharply from a rise of 6.9% in April, thanks to wage inflation now flowing through. Used car prices, along with airline tickets and the cost of recreation and culture, drove the increase, suggesting that price pressures have moved beyond food and energy into the rest of the economy. The cost of airfares rose by more than a year ago and is at a higher level than usual for May, said Grant Fitzner, ONS chief economist. Live music events and computer games also contributed to inflation remaining high. These were offset by a fall in the cost of petrol, and food price inflation remains high, but the rate did ease back slightly. May's surprise rise in core inflation will cast a large shadow over the Bank of England's June meeting tomorrow. In fact, a 50 basis point hike is possible, but they probably will do 25, and we may well see a minority vote for a bigger move and the central bank becoming a little more hawkish. It's looking increasingly likely that it will be a recession that will be needed to get the inflation genie back in the bottle, said Stuart Cole, chief macroeconomist at Equity Capital in London. It is possible that the bank will raise rates by 50 basis points tomorrow and will need to hike rates above 5.25% to get on top of core inflation, said Paul Dales, chief UK economist at Capital Economics. The acceleration in core inflation leaves the UK looking increasingly like the global outlier and the stagflation nation. Traders piled into wages for more Bank of England interest rate hikes. In fact, with money markets fully pricing in a rate that could hit 6% by December. And investors see a 50% chance that officials will opt for a larger half-point hike on Thursday. The Bank of England raised rates at 12 consecutive meetings from 0.1% to 4.5% and is now expected by economists to lift them by at least a quarter point to 4.75% on Thursday. Britain remains an outlier among major economies, with prices rising more than 4 times faster than the central bank's 2% target. And the Bank of England Governor Andrew Bailey is concerned about signs that inflation is remaining more persistent despite the quickest round of rate hikes in 4 decades. High headline inflation piles on the pressure for more rate hikes, said Yael Sefin, chief economist at KPMG in the UK. Today's data will likely leave the Bank of England with no choice but to opt for another increase in the base rate tomorrow. And in a separate report, the ONS also said that government debt climbed above 100% of GDP for the first time since 1961, after the government borrowed a greater than forecast £20 billion in May. The deficit, the second highest for the month since modern records began in 1993, was up from £9.4 billion a year earlier. The increase was driven by costs of living payments, including energy subsidies and higher staff costs. And of course, the figure will make it hard for Sunak to deliver the big tax cuts that many Conservatives say are needed if the party is to avoid a defeat in the general election expected to be held sometime next year. High inflation and rising interest rates are weighing heavily on the public finances as well. Debt servicing costs for May alone was £7.7 billion. That's £700 million more than the Office for Budget Responsibility forecast. And public sector strikes as workers demand pay to keep up with prices had delivered bigger pay deals than the government had planned. As a result, staff costs for May were £3.4 billion higher than last year, largely due to the NHS pay deal. And support for household energy bills cost £3.6 billion in May. That's £1.4 billion more than last year. And inflation will also add £2.9 billion to welfare spending as benefits are rated in line with inflation in April. Chancellor of the Exchequer Jeremy Hunt said that the priority is to fight inflation. We will not hesitate in our resolve to support the Bank of England as it seeks to squeeze inflation out of our economy, whilst also providing targeted support with the cost of living, Hunt said in a statement. We know how much high inflation hurts families and businesses across the country, and our plan to halve the rate this year is the best way we can keep costs and interest rates down. Inflation is actually falling more slowly in the UK, partly because falling commodity prices are passed on via regulated domestic energy bills with a lag. And also Britain has more than 500,000 people that dropped out of the jobs market during the pandemic, forcing companies to bid up wages to secure the staff they need. In fact, Bailey said last week that inflation will come down, but it is going to be taking a lot longer than expected, and he warned of a very tight jobs market, highlighting that many firms are hoarding workers given the... So traders are now expecting the Bank of England's key rate to reach 6% by December, which will mean another 150 basis points of increases this year. And it's worth reflecting on the fact that the UK has already been through the quickest tightening cycle in 40 years, and lifting the rate to 6% would add to the pressure on borrowers, dealing another blow to the housing market. And it would also raise questions about the outlook for the broader economy. Such a scale of monetary action would send the UK into a shallow recession. Gross domestic product would shrink about 0.3% this year and 1.4% in 2024. And many households are already struggling because of the cost of living crisis. And an additional squeeze, plus worries about the economy, would add to the political headaches for Prime Minister Rishi Sunak. Bearing in mind, of course, that his focus is on lowering inflation. And the fact that on Tuesday the Chancellor ruled out special mortgage support because it would only exacerbate price growth is so significant in its own right. By the way, the last time traders were so hawkish on the outlook for interest rates was in September last year, when former Prime Minister Liz Truss shocked markets with huge spending plans. But sticky inflation and a tight labour market have led them to ramp up tightening bets once again, in contrast to the peers in the US and the Eurozone, where policymakers are seen to be nearing the end of their tightening cycles. The shifting outlook would push UK bonds lower, lifting two-year gilt yields to the highest level since 2008. And just a month ago, bets were on the terminal rate of below 5%, and the market wages on additional BOE hikes contrast with expectations for the Federal Reserve and the European Central Bank, with no more than 2 more quarter-point increases expected. The UK is in a situation that is worse than Europe and the US. The risk of inflation expectations de-anchoring is the highest in the developed world, said Rafael Gallardo, chief economist at Carmignac Gestion SA. The Bank of England has to keep hiking. And the thing I want to say here is that this trend that we're seeing in the UK is actually quite close to where I think Australia is heading. We're a bit behind, of course, in Australia. The energy price shock is still to come. Interest rates are still to rise, and the impact of last rate rises are still to play out. But it seems to me that we are having a situation where rates are going to be higher for longer, as we discussed in our live stream yesterday. And the story from the UK should be an object lesson to us all. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.